All right, all right. What's going on, everybody? Good times. So we're back, and we made it through the FOMC. So where are we going from here? That seems to be the popular question. Where we're going from here? How we going to get there? How long is it going to take? Lots to think about. I think I'm going to stick with my original base case argument that all of this is going to take time and that we're not going to come out of it anytime soon. But we've seen some early signals, right? It's just signals. Think of it like when winter ends and spring begins, and you just start to see these little signals that summer's coming. And you know it ain't here yet. We were looking at blizzard conditions yesterday on the west side of Kansas, so it's certainly not here yet, but it's on the way. CTAs started to buy after an extreme drop to the downside. That is some of those signals we're talking about. Remember, we don't want to follow what they say because they got to put their money where their mouth is. So we want to look at what they're doing, not what they're saying. And sometimes, because they got to be tricky, they'll say they're buying and they're actually buying. Sometimes they'll say they're buying and they're not. They just want you to buy whatever they're selling. So we can't just always say that they're going to play, uh, games with us. But we can watch those CTAs and we can see what they're doing, and then we can watch money flows. There's a lot of tools for that, but there's also articles that come out where they'll use different ETFs and they'll keep track of inflows and outflows in those different ETFs and kind of use that as a gauge for how money is moving into or out of the US markets. So there's different ways, right? And it's not about intraday trading on that level. It's more about collectively looking at the week or at the month. At some point we'll be looking at the whole quarter. We're just not there yet. And everything so far says that this problem is a confidence problem. And until we have confidence in the US markets again, we're going to continue to see this problem. But and herein lies the tricky part. It's kind of like inflation and trying to kill inflation expectations. It's a self-sustaining beast. So when people fear rising inflation, they behave as if they have inflation already and start paying inflation prices. They start hoarding. They're trying to rearrange supply chains, just spending and increasing their inventories. We end up getting inflation just because of the fear of it. And then once we get it, we can't get rid of it. So, with this confidence issue, how do we get it back unless we start getting some buying? But why would we get any buying if we don't have the confidence? So, it's going to have to be these big firms that eventually do come in and start buying, and they will buy before anybody else because they're going to be the ones who actually generate the confidence. Everybody will see them buying and will start to get confident, but it will be too late at that point to be early buyers if you wait around for that confidence to show up. So it's almost a catch 22 on top of all of that, because if you're a confirmation trader, you have to sit and wait until you have confirmation. How long is that going to take? And if you don't wait for confirmation and you get in early, well, you could see price stay below 5,800 for the rest of the year, half the year, for the rest of the quarter. Doesn't necessarily mean it has to go lower, but it certainly doesn't have to go any higher either. So it puts us in a pickle, a little bit of a bind that no matter what decision we make, there's a lot of risk tied into it, and there's no good outcome. So I like to just do what I always do and be willing to hold for a longer term. I'm a young man, relatively speaking, so I've got time. I can buy something that is a good quality product and hang on to it without fear that it won't come back. May take a little longer than I want. And we can always shop around. It's a stock picker's market, so we can find things that are doing really good and focus on why they're doing good and evaluate if they're going to continue to do good or not. Checking to make sure that they're not only behaving well because of the lack of confidence, because if they are, when we start getting confidence back, we're going to lose those things. Orale. Hi, you guys. Someone just told me they couldn't hear me. I had the Discord muted. Probably should be good now, though. I do see I need to readjust some stream settings. Just a second. That should do it. All right. So, how's it going, everybody? Been a pretty wild week with POW and tariff talk. The tariffs are still the greatest threat on our horizon. There's a lot of things that are likely to get repriced if he does follow through with all the tariffs. And I'll tell you, it's been kind of difficult to keep up with the tariffs because they've changed their mind and changed their approach and changed the application enough now that I think I'd probably need to do a deep dive just to figure out what the actual tariff threat is for April 2nd. But one thing we do know is that it is timed for April 2nd. So we have that. Let me just check to make sure. Yeah, I had to make sure the audio was going through on YouTube. That was one of the problems we'd had before on the restreams. Cool, cool. It's good. So it's a confidence issue. The markets have sold off for a lack of confidence. Money has left the US, and we don't see it coming back anytime soon until we have answers to questions. And it's those lack of answers that caused a lack of confidence. It sounds really easy when you say it that way, right? Like, oh, we just need this one thing, but you can't go get it, right? It's not you can't just go buy confidence somewhere and bring it back. We're going to need to see trading activity that inspires confidence, and that's going to have to come from the big firms, and it's going to have to come from outside money sources. Let's see. I've got a CTA chart that I want to bring up and show you guys. The other day, I showed a CTA chart where we were down significantly. This was on the 18th, I believe. The idea was watch out with these CTAs. This is the SPX in white versus the CTA positioning in green. Watch out. they are so extremely oversold that we could see them start to pick up, do some buying at this level. That was on the 18th, so 2 days ago. We have an update on that from today. This would be one of those signals suggesting that we're getting some large trading activity at these extremes, but it's only one bit of information. We're going to need a lot more. All right, so this is from today. CTAs are starting to increase in their long positions. A lot of potential liquidity is coming in. This could just be a small bump, could be a start of the big rally back that we've been looking for. But when we talk about this big rally back, try to keep perspective and to highlight what that kind of perspective is going to look like. To discuss sort of patience that you may need, this is the 2022 bear market right here that we're looking at. It started in January of 2022 up here at these peaks, and we fell a long ways. And then we rallied back. And if you look at the measurement on that rally back, we'll just take it from the low to the high. We rallied all the way back and we broke through the half. And then we got this beautiful evening star reversal on a weekly. That is a really great trade setup, by the way. It's great for analysis, it's great for trading. So, evening star reversal, we flipped over, we broke the low end of that highest bar, and down we went. And then we fell a lot farther. So, we'll just move this whole thing and peak to trough. We bounced up, and that time we couldn't even make it to the half, right? And we fell down again. But as you can see, these are really big swings. These are the kind of swings that we're looking for, right? What's that old Star Trek, Star Wars phrase? These are the droids you're looking for. These are the ones we're looking for. So we're actually going to keep that drawing now from that lowest point to this highest point. There was our breakover, and an uglier version of the evening star reversal. It's not a great example. That last one was. This one's not. But still, a gap down on a weekly is a really good trade signal. So even though it wasn't a textbook evening star, it was a gap down on a weekly, which is a really nice setup. But see how these swings, it was dominant weeks. That's 1, 2, 3, 4 weeks in a row. And if we zoom in, I know it's kind of nasty. It's a lot of stuff to see on this chart. We closed near the high on that big expansion week, and we closed at the high on this big expansion week. The other two green weeks, there's some wicks there. We pulled back from the highs, but if we measured it, we closed above the midpoint and really close to the 75% mark. So it's still closed bullish. When we think about the current market environment and how we're all waiting for this move to the upside, please keep those examples in mind. We could see a green week. We could see 2 or 3 or 4 green weeks. It doesn't mean that we're going back to those highs. So we're going to get a move up. That's almost a guarantee. It has to happen at some point. Whether we're going to get 1 week or 2 weeks, we make it back to the half or we overshoot the half, it won't solve the problem. The problem being the lack of confidence in US markets because we have, such unknown threats hanging over the market like these tariffs that we just don't have enough information about, right? Those tariffs are the real deal. Marziti, I didn't hear you talking to me, so let me check that and figure out why. ¿Por qué, güey? I don't have you muted. Oh, you know what? The other day, I was using a different set of headphones, and maybe, just maybe, it's still set on those headphones. Try it now, homie. I got you. I hear that. Pimping ain't easy, but it sure is fun. I mean, someday eventually this will all get washed out, but until we get that confidence back, I don't believe the problem is solved. And if the problem's not solved, then we're not going to go up to the previous highs, but we're going to make a move up. And that can be a new opportunity to short. It could just be, a fun trade to the upside for a couple of days, maybe a couple of weeks. Sure, no argument on any of those. I just want to temper people's expectations that we're not going to revert back to our old ways. The problem isn't solved. And right now, the April 2nd tariff uh, deadline is what the entire world is looking at to try to decide if and when they're ready to come back to the US. There is a lot of economists that are arguing about the tariffs and how the tariffs are going to impact the United States. Um, there's also a lot of economists that are arguing about what he needs because it's not just the tariffs. He needs Congress, the House, the Senate. They've got to change the way we spend. They've got to change so much, and they're not getting that. This was supposed to be a package deal with energy and a reduction in government. Um, it was like a four-prong, five-prong attack of all these different things that needed to be done. And he's not accomplishing any of those, not from a lack of effort, just from a lack of obstruction. Everywhere he goes, everything he touches, it doesn't matter what it is, there's somebody fighting him on it. And it's not for me to say that he's right or he's wrong or that that it's going to work or that it won't work. Keep politics out of it. He is running the current administration. The administration has goals, and the only thing so far that this administration has managed to do is break confidence in US markets, and money has fled the US. Nobody knows when it's going to come back, but it will come back. We have, really great companies. We have strict rules on how those companies report earnings. And one of the reasons that China was, quote, uninvestable a few years back is because you couldn't trust their earnings. They had government subsidizing the companies. They had a lot of really ornery rules about how they would allow other companies to integrate with them. And you just really just couldn't trust the data. And sure, it's easy to pick on China when it comes to not trusting the data, but they're not the only one. A lot of nations, they fudge the reports more than they should, and they get away with it. In the U.S., hey, I'm not trying to say that our companies are sterling in their reputation, but the markets have enough information that they will pry out, reports and numbers that don't look right and get to the bottom of things. And so I, for an example, feel pretty confident about the companies that I trade that they're not going to disappear tomorrow. They're not going to blow up and be out of business in 2 weeks. That they're a good company with a solid moat, making money, and they're going to be here next year. So I can, you know, buy stock and expect them to still be around. Money will come back to the US. Whether or not it comes back during this president's term, debatable. So we just have to continue to look for these signs that money's coming back, like the CTA chart that I was showing. On the 18th, we saw that they were way oversold. We were looking for CTAs to begin buying, and then this morning we saw that they have started buying. They're working their way back up. We've got firms like Goldman Sachs suggesting that they see a few billion in profit or a few billion in purchases coming in the next month. That's supposed to equal like a two standard deviation move in the market. So sure, we could bounce, get 50%, maybe a bit more to the upside, like I was showing. But I wouldn't expect the problem to be solved until we get some real clarity on these tariffs. So nothing less than April 2nd. Now, when I was talking to myself, when it was still muted, I had mentioned that this confidence issue is a bit like the inflation issue. Once people have it in their mind that we have inflation, it's really hard to get rid of it. We have really high inflation expectations, inflation survey estimates, and inflation is just sticky and it won't go away. It's because everybody's got it in their mind that inflation is here. Everything they look at, everything that they do, they just blame it all on inflation. And of course, companies take advantage of it. They raise costs on prices and they just get it while the getting's good. And so we have it and we can't get rid of it. When it comes to confidence, it's going to take some really big buying, a lot of money flow before we start to get that confidence back. But why would any money come in? Why would that money start to flow without confidence? It's a catch 22. So if you're a confirmation trader and you're waiting for that confidence, you'll be too late. It's not necessarily the right word. You'll be late, not too late. You'll be late to the party because if you're waiting for that confirmation, by the time you get it, we'll have already made a significant amount of recovery back in the other direction. But when it comes to our retirement, our long term holdings, and our big purchases, our big trades, we want some sort of idea that the trade is going to work. So we have to come to some kind of middle ground, find a way to start getting into things while still maintaining that expectation that it might not come back around for a while and that in fact it could get worse before it gets better. Generally, the approach on that is to add in. Um, it's not a popular way to do it, but dollar cost averaging has been around for a long time because it works. It's a horrible way to fix a losing trade, but that requires that you actually consider the trade to be losing in the first place. And that's not what we're talking about. We're just talking about, say, if I was selling motorcycles and I sell you one at 1,000 and you think, well, that was a really good deal. It's excellent. I just seen one online. It was $1,500 and I just bought it from you for 1,000. And then next week you come by and you see that I have it on sale for 800 and you're not going to feel good about that $1,000 anymore. You're going to say, shoot, I should have just waited. Now I could have got it for 800 bucks. Well, maybe your wife wants one. You buy her one. So now you got two. You didn't really need two, but I mean, it's $800. That's cheap. It's a steal. Can't pass that up. So you buy another one. If you're looking at some companies and you really like those companies and they're down right now, but you know that they're good companies and you buy it, and then next week or next month it falls a little lower, do you what? You just stopped liking the company? No, you probably still like the company, probably think it's going to stick around for a long time, that it makes good products, it has good earnings, it's run by good people, and you're getting a better price on it than you bought it last week. Why not buy a little bit more of it if you can? So it's really a matter of perspective. That does make it hard to shop around on some of these smaller name companies or companies that are in a newer space. I've been looking at electric vehicle takeoff and landing companies, flying taxis and drones, that sort of stuff. It's hard to get behind that with a large position because it's hard to have confidence in something so new. And they're small companies, and that makes them a little scary. Quantum as a service, quantum names, those are kind of hard to get behind too. But a year and a half ago, biotechnology was really scary. It was hard to get behind a lot of biotechnology companies. And then AI came out and it really started to make that a lot easier. Because to me, biotechnology is like the scary thing to trade. I just don't know much about biotech. It seemed like most of those were really thin, that they fit all the classic signs of pump and dump companies, and I just didn't like them. But over the last 12 to 18 months, I see them way more secure and stable as a company and as an industry and a sector than quantum or electric vehicle takeoff and landing and drones flying taxi companies. So maybe just stay in your lane. I guess it's a nice way to say it. Focus on companies that you know, you understand, that you trust, that you like, that you're willing to hang on to for a while. And of course, we're talking about longer term trades here. That doesn't necessarily fit into, I'm just taking it for a spin around the block. 2 or 3 weeks, 2 or 3 days. Sure, why not? It doesn't really need all of those qualifications for a short term trade. So I would continue to recommend people shop around, find things that you would like to own, and uh, start putting together a plan for how do you want to own it. Nothing is too expensive, by the way. With companies like Robinhood and others, you can buy a fraction of a share. And even if you don't have Robinhood, Fidelity offers that. You know, if you want something a little more legacy or old school, I think Schwab does it. There's a number of companies that offer fractional shares. So even if you have, say, $400, you could buy $25 of Apple, $25 of Google. You know what I mean? You could get the whole Mag 7 and own a little bit of all of it. You would still make money because they are going to come back. Just the how and the when to be determined. So April 2nd is the timeline we're all looking at. Um, we can jump through some charts, kind of take a look at any signals that might imply we're going to see some move to the upside anytime soon. Some ratio charts and tools. Before we jump over there, though, let's go back to the SPX for a moment. In Spot Gamma's report, they laid out how 5,700 is a really big deal. So I got the SPX here, and I'm just going to zoom in, and we'll just draw a line at 5,700. You can do it that way, or you got this really big red bar right here. This is the March 10 bar. Just drag that line over to where that day opened. It's 5705.37. We haven't managed to make it through there and close above it. We've tried 3 times. They took a front run to it. We overshot it. They slammed it back down. We tried it again and they slammed it back down. That is the line in the sand at this point. If we manage to get through that line, which we will eventually, the gap close is all the way up here, 5770. That is the gap close. Now I know I do my gaps a little differently than other analysts. As far as I'm concerned, we closed here. and we opened here. And that is the gap that needs closed because I don't know. It's just the way my mind works. So I don't care about this little visual gap. That makes me no mind. I don't care. I'm just focused on where we closed versus where we opened. And we got to resolve that, right? The gap isn't closed until we go back to where we left. Makes sense to me. So once we do get above 5,700, that is where we have to go next, right? We got to get to that. And it's very likely that we will once we get a close above 5705.37. The thing is, and we've seen this before, the day that we actually break solidly above this 5705, we're likely to go all the way to 5710 in the same day. It's not like we're going to break up here, close, and then the next day open and continue to run. That's possible, of course, right? Price can do what it wants. What's more likely is we'll make the whole run in a single shot, and we'll either get there and reject, or we'll get there and we'll close through it on the other side. So that's a play when we get one. The day that you see us break above 5703 with some push behind it, the ticks into the 750s and 800s, the mag 7 moving to the upside with us, we will probably have market breadth. So we'd have the financials, consumer discretionary. It could even be a rising tide, and we'll have every sector green that day. We want to see a lot of push and a lot of flow, and we don't want the breakover to be late in the day. We don't want it to be one of those 2 o'clock in the afternoon spike news events that gets us ripping to the upside, because then it's likely to stall and not make it the whole trip. We want a break above that pretty early in the day, say by 10:30 or 11 o'clock in the morning. And this is the SPX, so we're not talking about any overnight moves. That'd be what we're looking for. We also have a gap in the other direction to focus on. Gap right here. This is 5614.65. Same thing. If we closed there and we opened here, then there is a gap that needs to be resolved. And oddly enough, I still see analysts who say there's no gap here. Huh? How can there not be a gap here? But whatever, you do you. We got another one down here. If we closed here and we opened here, then we have a gap that needs to be resolved. These are daily gaps. Um, they're not bad. Weeklies are better if you can find them. Weeklies gapped at the edges of a high or a low range, even better. Tie it in with something like an evening star or a morning star reversal, and then it gets really good. We're not supposed to have that sort of setup in this environment because we're not at the low and we're not on a weekly. But besides that, we're not on the low. But we can keep these things in mind. If we go to the downside and we get to 5614.65, that will be a gap close. We could overshoot it and see the low of that day, but that would be where we expect to see them defend and buy back up again. If they don't and we get through this zone, then we want to focus on the start of this gap, which would be this 55.63.85 area. That would be the start of this channel down here. That'll be our target. So break March 18th low. That's when the CTAs were still heavily extended in their negative environment. Break that, target this. Break that, target that. We got good plays here. We got things that we can do. The options market is still pretty nasty out there. There are things to trade, yes, but money is really concentrating into the absolutely most liquid stuff or things that are getting a lot of attention in the media. If you just look around at the common names that you would expect to have liquidity, not so much. So that's been a bit of an issue. But if you are shopping around for things that you like, try to find things that do have options so that you can defend your positions if you need to. I was reading a spot gamma no, excuse me, it was a Seeking Alpha article about these two ETFs for gold. And gold's a tricky one when you're trying to find good gold ETFs that have liquidity. And they were like, these are totally liquid products. I'm like, oh, great. That sounds awesome. How did I not know? Let's go check this article out. So I'm in there and I'm reading it, and they're just not liquid. I guess their perceptions of liquidity are perhaps a little different than mine. Maybe I'm just a liquidity snob, but they also didn't have options. Not that they didn't have liquid options, they just straight up didn't offer options. And we're talking $80 products, $60 products. I'm not buying something at $60 a share that doesn't have options. I can't defend the trade, can't protect my position. I can't do anything except have a binary position of winning and losing. Nah, I don't think so. So when you're shopping around, just try to find things that you can defend or keep your position small enough that it doesn't need to be defended. So with the SPX, we got that 5700. We need to get through it. Seeking Alpha article aside, if we um, do see moves in gold, that's likely connected to the war or the dollar, right? So if gold's been a little bit of a war vibe, if we see things in Ukraine, Russia pick up, or if we see things with um, Israel pick up, then we could see some moves in the gold space. Otherwise, the dollar dropping like it did, if it starts to rise, we're likely to see gold fall. A bit of an inverse product there. For this, for the S&P, the broader market, since we're waiting on that confidence issue, um, Spot Gamma says 57 likely holds into the April 2nd tariffs. Kind of implies you could do some call credit spreads at or around the 5700 area because they're not expecting us to get and stay above that until after the tariffs. I wouldn't wait until the day of the tariffs either. If tariffs are April 2nd, I would have it out by the 1st. We can see that April 1st, April Fool's Day would be Tuesday. So you can get out of your position before the 2nd, which is the Wednesday. I wouldn't wait, right? That's kind of the idea. So there is something, along those lines to think about. This is T-Dex, tail Dex. What it's gauging is how expensive are the put options in the SPX. If you think about it, that's a pretty unique tool, all right? Because we can go and we can add something like the VIX. Looks like I already have that added. Let's just turn it on. There it is. We can see that the VIX is elevated, and then it started to fall after the March 10 spike. And as the puts have fallen, so has the price of those puts. And that implies that they're not buying puts. They're not looking for us to go lower. If they start shopping for lower levels, they'll start buying puts. We'll start to see the T-Dex begin to rise back up again. Now, the VIX is looking at SPX options. And this is looking at XPX options. This is how many of those options are traded, and this is the cost of those options when they were traded. So they're not buying them, and if they are trading them, then they're not jacking the price up, right? TDEX. I'm not sure what the symbol would be on Thinkorswim. That's a good question. Some of these tools that you can find on TradingView, you won't necessarily find anywhere else. But on Thinkorswim, if you're looking for a tool, try the dollar sign. So it would be dollar sign TE TDEX. If that doesn't work, then I'm not sure, right? But When we use things like the tick, we use $TICK, and you can also try something like the indicators tab, see if you can find it in here. Since I tried it and it didn't show up, I don't expect to find it now, but that's what I would do if you're trying to find it on Thinkorswim. If you don't have TradingView, you could also just try to do Google. Somebody may have a website somewhere where they're just running like different market breadth tools, and they may have a running chart on TDEX. And check Twitter if you don't have TradingView. It's very likely that somebody is publishing a TDEX chart at least once a day, once every other day. And it's not like you need to have 24-hour access to this thing, right? So if you don't have TradingView, there's always something you can look at. All right, we've talked about this one before. In pink is the QQQ, just typical NASDAQ. You see the little label that I have here. And in blue, it's a blue area chart. I've got the ratio. It's weighted versus unweighted QQQ. And I've marked December 24th of last year because that's when this thing really stopped falling and began this sharp rise to the upside. And that's what we want to focus on. When this is going to the upside, the MAG 7 is underperforming the broader market. And if you're new to this logic, the MAG 7 has been carrying the market since January 2023. So everything else was flat to negative, but the MAG 7 was doing all the heavy lifting, and we rallied for almost a year. We can see it here in 2023, January, it's the start of the new year, and we just took that rip in the Qs, and this fell the whole time, right? Of course, we had a little dip to the downside here and here. We see a little dip, to the upside as this was falling, this was rising. So we've been getting this sustained drive to the upside, and for a little while, the Nasdaq was fighting against that. But finally, we started to fall. So if we're looking for the MAG 7 to uh, at least work with the market, doesn't necessarily need to carry us like it did last time, but at least work with the market, then we would expect this to start going sideways again, like it did back here for a while. It was going sideways because that would mean that we're not going to continue to sell off more. Look at the pink line. When we were going sideways on the blue, we really didn't drop too badly until the blue started to fall again. So, these sideways areas line up with sideways QQQ, or at least a ranged QQQ. See if we can zoom in here a little bit without losing the tags. Ow, screw the tags. So we want to see this range continue if we want this range to continue in the Qs. Otherwise, we want the blue line to fall and we want to see the Qs begin to rise back up again. And it'll be based on market breadth from some of the hyperscalers like Apple, Amazon, Nvidia, Tesla, Google, Meta, the same players that it always is. We need them and we don't have them yet. That's the takeaway here. In fact, it's primed like it's ready to start going higher again, right? It's at the top of the range, not at the bottom of the range. What's interesting is the Qs are not at the bottom of the range. So if this is ready to break higher, the Qs should be ready to break lower, and they're not. They're also near the top of the range. Yeah, I'm a nerd. I know. All right, so here we've got the MAG 7. It's a little homemade ETF. You don't need to go as nerd as this with weights and everything to it. You can just type in Meta plus Microsoft plus Tesla plus Netflix and Google, and you can make your own version of this. You don't even need to do that. There's something called a NY Fang and or an MAGS. And if you go to that, it'll look very similar, right? We just jump back over here to a regular chart. This is the Magnificent 7 ETF, and it's just as good as that one with all the names added together, right? So if you are on a platform where you can't add all the names together to make your own little homemade ETF, just look at the MAGS. It's good enough. I promise you won't notice the difference. It just makes us feel good and special to have these unique tools where we can say, look what I did, and I put the weights in it, and I'm special. Just got to take my crayons away so I don't eat them all. So what this is showing is that the Mag 7 collectively are down and they're not breaking to the upside. There are some good products out there if you want to dig deeper into the Mag 7. There's two ETFs that I like to use, and we look at them in the morning briefing. One is the FNGD, that's the FANG's down volume, and the other one is the FNGU, which is the FANG up volume. And so you can see what the total maximum up and down volume is, and you can actually put those two charts together to make a ratio chart to see if the up volume is dominant or the down volume is dominant. That allows you to look for divergence signals between the Mag 7 chart going up or down and whether it was going up on down volume or down on up volume. Insightful, to say the least, right? Just different tools that are out there. So it's FNGU for up and FNGD for down. Don't worry if you don't remember all this. I'm recording so you can catch the replay. The cool thing is the FNG up and down, you can see those on Thinkorswim. You don't need TradingView for those. And then you can also make the ratio chart on Thinkorswim. It's really nice. So Mag 7 is down. We're in a bit of a bear flag at the moment. And since we haven't continued to go lower yet, we don't know if this is going to turn into a failed flag or not. I will say it's gone sideways longer than I typically expect a bear flag to last, but we're on a daily. And so, on a daily, we can get the flag on the pole to last quite a while. So it's not a failed flag yet, but I think if we stay here for much longer, we'll be looking for it to become a failed flag. If it is a failed flag, we'll look for it to run back up. It'll form eventually this really big cup. So here's the pole, and then here's the flag. If it fails, we'll look for this, and it'll be a really big cup. That's the idea. If it doesn't fail, then here's the pole, there's the flag, and we'll look for the next break lower, which would put us into the 1, 2, 3, 6, and then we'd look to do the whole thing over again. We're not there yet. We need to come out of this range, but that's what we're focused on. That's the Mag 7. We don't have them. We don't have the market, right? It really looks like one of my charts got wiped out, but I'll get it later. All right, so this is IWF, IWD, growth versus value. Oddly enough, it's the Russell's version of growth versus value, and it works really well with the Mag 7. Don't even ask me to explain that because it doesn't make any sense to me either. But that's just the way it is. It works really good if you're tracking the Mag 7. When this thing breaks back above 2.0, buying the Mag 7 is a really good play. Preferably tie that in with a stochastics that's rising up from under the 20 level And or if you like the MACD, use the MACD. So you want a crossover in stochastics, moving to the upside, cross this thing back above 2. It'd be a really nice time to buy the Mag 7, but we don't have it yet. 2 is not a magic number, by the way. If we happen to get solidly below this 1.95 and say we get to chopping around like 1.92, 9.1, 9.3, something like that, then 1.95 will be the breakover point. We'll be looking to get through that as a run to the upside and a signal to trade in the Mag 7. So those are swag levels, right? SWAG. You have to be adaptive with this stuff, right? So right now, since we haven't gone below the 1.95 and sustained a move down lower, then we're still using 2.0. This is telling us we don't have a Mag 7 play yet. Now, as a growth versus value tool, it doesn't do a really good job. My complaint with it is that it works really good for the Mag 7. It doesn't work really good for the rest of the market. So if I'm trying to collectively look at growth versus value, that thing sucks. But silver, not silver, SLYG, SLYV, this is the S&P's version of growth versus value, and it does a much better job. I don't want to say it's perfect, but if you're looking for growth versus value, this does a lot better. Funny enough, if you just put them both on the screen and they're both making moves to the upside, yeah, that works. Then you've got your growth versus value, and you know that it's dominated by the Mag 7. Because you can get solid growth, you could just get stalled value, and it'll look like solid growth, right? You know what I mean? Because growth versus value doesn't mean that one's going up and one's going down. They can both be going up with one outperforming the other. So having them both on there, and we can see growth collectively doing good on both sides would help. Or, just seeing one side, then it kind of gives us some insight. So this is saying it it's not up at the top here where we had a nice breakout and it tried to run, and it's not trying to break down through the lows. It is just giving us these lower highs and these lower lows after that last run in like mid-February, right? First week of February. So since that high, lows, lower high, lower low, lower high, lower low, lower high. Kind of get the idea here. We got to break this high if we're going to break this trend. And that's what we're in, because that's what you call a trend. Lower highs and lower lows consistently and consecutively. That is a trend. That has to break. And so far, we have no signal of that breaking. And when we look back at the Mag 7, they sure look like they want to go lower, right? I mean, that growth versus value ratio right here, it really looks bearish. So, yeah, no, we don't have growth versus value yet. Still no signal to go long. Now this is intraday stuff. I don't know. Anybody day trade around here? That's a joke. Right? I'm sure someone does. US 30 by Japan 30. This will act very much like the S&P. Well, yeah, what's day trading? Never heard of that. People do that? So with this, since it mimics the S&P really well, and it's open in the Globex while the SPX is not, then you get a little bit of insight for those who maybe don't trade futures and are not using SPY. But either way, keeping track of this really helps to confirm reversals, because you can get a spike in the S&P that isn't confirmed in this, and you kind of realize that the spike is fake. And then you've got the BXM, which is the Buy Right Monthly Index. Don't let that very complicated name confuse you. It is just a reflection of call buying versus put buying. It doesn't have to be any more complicated than that. If this is going up, calls are dominant, it's bullish the market. If this is going down, puts are dominant, it's bearish the market. So if we see a spike in the S&P and we don't get a spike in call volume or call trading, excuse me, and we don't get a spike in the US 30 versus Japan 30, then that spike in the S&P is very likely fake, or it's driven exclusively by SPX trading alone, not being carried by the broader market and not being affected by yields or dollar or anything like that. So it is a tell, handy too. You should be able to see these tools on most brokers. There's nothing special about the buy right monthly index and of course the SPX to SPX. So the only one that may give you problems is if you're on a broker or a platform that won't let you do a ratio because you need US 30 minus Japan 30. But I like this combo when I'm looking for something and I'm trying to figure out what's driving the market. When I'm stuck on one of those days where the dollar's not doing what I thought it should, or the 10 years not doing what I thought it should, and I'm looking around and I'm trying to figure out what the heck is moving the market. Because most of the time, that's a pretty easy thing to answer. Some days, we have no idea what the heck is moving things. And this is useful for trying to suss that out and figure out what's moving things. Using that same ratio, US 30 by Japan 30, we can put all three together. So I've got the ratio in blue, the S&P in orange, and the Qs in cyan here. And that's a weekly chart. So we're back to swing trade talk. Collectively, they work as a group, but groups generally do better when you have a leader. And the leader is the pair US 30 by Japan 30. It'll often make the move first, and then the indexes follow. If they don't, then we have a divergence and we look for one of them to play catch up. We start trying to figure out who's lying or who's wrong. So as you can see, Japan moved to the downside was not nearly as much as the move that we got from the S&P and from the Qs. It was still a good move. All three went down, and if I zoom in, they'll start to get mixed up. But don't let which one is on top or bottom change your point of view about anything. It doesn't matter which one's on top or which one's on bottom. We just want to look at what they're doing. Are they sloping down together? Do they all have this uptick together? And now that I've zoomed in, take a look at the cues there. People that know me know I'm missing fingers, but I've got like a partial pinky that I can wiggle at people from time to time, like a nub. Well, that little nub there in the cues is pointing to the downside. And the little nub here on the S&P is pointed to the upside. But look at this Japan ratio. It's sharply higher, and it's gone higher than either of these two have moved in their perspective or respective positions. The Qs are the outlier here. If we're looking for the liar, it's very likely the Qs. We don't know that for sure. What we do know for sure is that we have an outlier. One of these is off, that it's not participating with the group. And that tells us that we can go look for other things. We can start with what makes the Qs different than the S&P. The Qs have no financials in them, right? The NASDAQ 100 doesn't carry financial companies. So we could look to see if financials in the S&P are doing anything that may help it go up. The S&P also, generally speaking, tends to have a heavier weight in value versus growth, takes us back in that direction. So if tech is down and it's dragging the Qs lower, and the Qs don't have anything like extra value names that can help make it mimic what the S&P is doing, then that'll explain why we're divergent. So we can figure it out, right? We can go in and we can ask questions, which is what charts like this lead us to do, is get more information. This is also saying we're not looking for a drive to the upside yet. We're getting some minor signals of long activity, but that ties us back to the CTAs that are buying. We already knew we had minor buying to the upside. That's not a surprise. It's just not very much yet. And obviously, it's not in the Mag 7, which we kind of need. That reflects back towards the morning briefing when we point out something like pot stocks and uranium is leading. You're like, yeah, we don't want to rally on pot stocks and uranium, right? That's not sustainable. So then we have the ratio again here on the daily. I removed, or I just turned them off, the other two. So the Nasdaq could be turned on, and so could the S&P. Don't need those. Just turn them off so we can just see the ratio itself on a daily. We had that March 7, excuse me, March 10 drop. If you think about the S&P and the Nasdaq, well, look at what this was doing before that drop. It was already dropping from the 7th through the 10th on down. We finally started to bounce on the 13th, and it's been trying to work its way back up. That's Thursday and Friday of last week for those that are thinking about the calendar. My birthday was last week, so I got the calendar pretty much figured out for this month. So we started that drive back up, but it seems like we're stalling out here a little bit. And then we have it on the hourly so that we can look at this bounce in more detail. And when we do that, we can add a tool like Linrig, just normalize this. We can see that we're on the lower edge of the channel on this drive back up. So kind of needs to hold this bounce and continue to work its way to the upside, or we're going to break down and test the other direction, which would mean we're going to start to agree with the Qs rather than with the S&P. So all of this is confirming that we don't have the Mag 7. We've got minor buying beginning and that it's not spread out yet. This is a much bigger chart. We're on a monthly time frame here. And this is the NASDAQ versus the S&P, but it's IXIC. I know it'd be much easier if we just put the QQQ in there. But this is the NASDAQ composite, not the NASDAQ 100, right? So it's the big NASDAQ. I suppose you could do it with the Qs. I think you'll get a different chart though, right? Because I think it would just be different. This is a really good perspective on technology, software as a service, um, old technology companies like Dell and HP, new companies, quantum, cloud services, tech, chips. So when this is going down, those aren't doing good. And we've had some critical lines in the sand over the years. When we look at these lows, or at least my dotted lines. And I've got a much smaller ratio uh, Linreg line on right now. Kind of just zoom in here a little bit. And we're testing that low. Now we tested it back here in August. If you guys remember that August sell-off that we had when the VIX spiked up into 65 and the S&P dropped really hard, and it was a bit violent. That's when we were turning things around here and we started working our way back up, but we couldn't get through that top. They tried and they just defended it too much, couldn't get through. And we're back down along these lows. I'm going to remove this channel for a moment because I think it'll help kind of make things a little easier for what I'm about to do. We've got all these wicks down here. So we can see their defense. We can see they keep picking it back up along that 3.1 area. And they're likely going to continue to do that until they don't. And if we take it back a little bit farther, this is actually showing front running because they were doing it at a much lower spot. So that kind of 3.4 area is the line in the sand that we absolutely do not want to break. But it's looking pretty rough. 3 down months in a row in this thing. And we're getting into a critical area. We want to start seeing an outcome here, but they're monthly candles. It's going to take time, right? We don't get answers quickly here. So unless we get really big moves, and there's been times where, in 1 month we've had big candles. Unless we start getting some bigger candles, we're not going to get any answers too quickly here. Just that this don't look good. It certainly doesn't look like it's turning around and going back the other direction. This is not suggesting in any way that we should be looking at tech stocks and chips and communications and software and cloud services. None of that stuff. Why I have both of the yeah, I was building out a 10-year instead of a 30-year, wondering if it would do any difference. Um, I'm not overly impressed with it, but you never know until you try. That's why there's two of these. This is the 30 and that is the 10. Since, the 10-year and the TNX, TLT, we tend to watch that quite a bit. I thought it could be more responsive, but if you look at the 10-year with the JP10, you can see we're building out like this head and shoulders at the high of day. And yet, if you look at the bottom right, we've already left the high of day. We fell back down. We're near the low of the day. And if you look at the S&P, same thing. We had that like rounded reversal. We're all the way back down here. We bounced off the open, for goodness sakes. So when I look at this 10, I'm like, yeah, no, it didn't work. But like I said, you never know. You just got to try and see what you get. This one is better. It more accurately reflects the intraday behavior that we're dealing with. So we'll just get rid of that. So what do you guys think of that? It seems pretty clear, huh? So what we're looking at here is the NASDAQ 100 and how many stocks in the NASDAQ 100 are above their 200 period moving average. I noticed a post from, I think it was Mentor Q, maybe one of the other ones, and they were highlighting how many stocks were above their 5 period moving average. I thought, boy, talking about bringing it up front. I guess, right? You got to start somewhere. If we are looking for things to turn around, looking at things that are above their 5 period moving average may not necessarily be a bad way to go. And there are tools out there that help us do that. So this one, if we just look at what it's built off of, oh, that's actually the indicator. There is, well, I guess we can use this then. We'll just open up this indicator rather than going through the market tools. And we can choose what exchange we want. So I'm looking at the NASDAQ 100, but I could choose the S&P 100, the S&P 500, and then what interval do I want? We're looking at how many are above their 200 period moving average, but let's dial it down to a 5 and see what that answer looks like. It's going to have to think about that for a moment, I'm sure. And I want to get rid of this, or at least change the words so that we don't get confused. And I have it set to Heikin-Ashi because otherwise it would look kind of gappy and really wicky. And we can put moving averages in there if we want to. That is a lot of stocks that are now above their 5-period moving average. It almost looks a bit extreme now that I've zoomed in on it. And you can see where a lot of these turned over when we were extreme to the downside. And I got the S&P above rather than the NASDAQ, but you can see that big move to the downside, lots of stocks underneath their 5. And then the next day, big gap up, and it continued higher. Look at all those green days in a row. We started to get negative, big drop down, another negative here, actually, instead of here. That's weird. Big move down, another big move down, another big move down. So on these up moves, little bitty doji here. We are on a weekly. I'll jump to a daily in a moment. That's like a spinning top candle. Or we put those two together, it's a bullish arami. Look at it on a daily. This says we've got some room to the upside, looking at this high here or this high back here. We're not at the extremes, but we're getting there. We're really close. I wouldn't try taking a bunch of longs with this already at that level. And I don't like those wicks that we've been seeing around 5,700. Now, don't get me wrong, whatever's up there that we've been hitting, all of that liquidity, we could have been absorbing it each time we hit it. And of course, if we keep doing that, we'll absorb everything that's there and then we'll move past it and we'll go up. But there's also the other argument, the other side of the coin, that if you put in the work and you don't get the results that you're looking for, eventually you're just going to quit putting in the work. How many times are we going to be able to hit that level and get rejected before the market says, let's go the other way? Of course, April 2 is still the deadline. It's still the number and the line in the sand that we've got to be concerned about. But what I was wondering today is, what if we start shopping around for some lottery tickets, right? And of course, a lottery ticket, if you think about going to the gas station, spending $2, getting a scratch lotto, they're offering you millions of dollars, and all you have to risk is $2. Why? Well, because your chances of winning are really, really low. But the payout is so great that you're like, yeah, I know I have no chance in hell of actually winning, but it's $2, so I'm going to do it anyways. And you buy a lottery ticket. That's what we would be talking about here. Shopping around for some lottery tickets, something really cheap, not defendable in any way. If it doesn't work, you're just going to lose. But the loss would be so small that we look at it and we say, whatever, I'm not worried about losing that. It's $2. So what do we got? We know the time frame. We don't have to use something that is going to expire before April 2. We just have to be prepared to get out before April 2 because of those tariffs, right? So 13 days. Let's close that up for a moment. Start with, are there any signals on the right side that would point us to a particular direction? These numbers on the right, this is the implied volatility average for all of the options chains that we're looking at. We choose an expiration date, and it'll tell us the average IV of the options within that expiration. This implied volatility will rise or fall based on the amount of options trading within that particular expiration. If they're doing a lot of trading in there, it'll get higher or lower. A cool little tip when it comes to the volatility that's on the side here is the statistical average. And if you've gone through my videos, you might have already heard this, but 16 is equal to a 1% move in the market. So if you're trading some crazy high flyer, say like one of those quantum names, and it has 140 average IV on the right side, just divide that by 16, and that'll tell you the average daily move or the average expected move for that expiration. We're looking at 4 days, 1%, right? That lines up. 16 is about a 1% move. That's pretty neat, I guess, if you're a nerd. You like it? So, if we're looking for expensive options, or we're just looking for options that are getting traded a lot, then we'll see a higher implied vol. But the farther we go out in time, we'll also see a higher vol because things have too much uncertainty when you go farther out. And so volatility goes higher because we just don't know enough, right? When we don't know, we have concerns. Concerns equal volatility. So the number should go up as we go farther out in time. What we're really looking for is anything that really stands out, a wild number. We don't have one, but we wanted to look. If we didn't look, we might have missed one that said like 60, 8 days out. We didn't have that, but what if we did and we didn't even look? We would have missed it. So nothing stands out too heavy. We can see they're trading pretty strong this afternoon, as they should, right? So it's a heavily day traded product, the S&P. So we expect to see that. It's a bit light for Friday. That's that 16 one that we were looking at. We can see a couple of strikes in here that they're trading pretty heavy, but I don't think we're going to find anything really cheap uh, in that window that we want, right? So let's go out to at least April 2nd. And we want to think about out of the money stuff, getting above 57 first. That would be our line in the sand because that's what Spot Gamma had already talked about. How much farther beyond that could we consider going? It says 170. So from 57 plus another 170, that'd be 58.70. I'm betting that's not going to be cheap, even way out there at 58.70. $7.90. That is not a lottery ticket. So one thing that we can do is turn that into a call debit spread. I don't really like this because even this, you can see it's $70. We're supposed to be looking for a $2 lotto, not a $70 meal, right? Go to the restaurant. But you could put a butterfly on for $5. I know it's a little more expensive than that $2 lottery, but it's $5 plus commissions. I don't want to lose, but that's pretty cheap, right? I could lose $5. I won't cry about it. We can't make it any smaller than $5 because the SPX is a nickel priced increment. You just can't get it any cheaper than 5 cents. So, if this was the SPY, we could go to 1 penny, but in the SPX, 5 is as cheap as it gets. But what if we widen it out some? So instead of using 65.75, let's try using something like 60.80. Missed. So the price got a little more expensive, but we've seen it fluctuating when I was on the other one. I would put this at 5 cents and I would try to work the order. Also, if we look at the side here, if we shift things just a little bit, we can sometimes land at something that's getting some intraday volume, even if it, doesn't give us exactly the number that we were looking for off the side here. Sometimes it's just better to adjust a tiny bit. There's nothing really getting heavily traded out here that would help us with this butterfly necessarily, but let's go to 75. Let's put 75 in the middle because that at least has a little volume today. And then let's try 90 on the upside because that had some volume right there. So that's 15 points. Thank you, baby. And then the 60 already had some volume. So now we've got 3 strikes that all have volume. It's not perfect, right? But we can see it's actually moving around again. And I would try to work that order, 5 cents, maybe 10 if you were, willing to splurge on your lottery tickets. But you don't want to compromise here, right? If it's supposed to be a lottery, keep it a lottery. If you don't mind spending $40 to take a trade with some width to it, because that's 30 points wide, then spend $40 on it, right? It's fine. This has 13 days. It has enough time to be defended. How could you defend it? Well, you could roll it, break it apart. A butterfly has a call credit spread and a call debit spread in it. At the bare minimum, you could buy back the short legs and you'd have 2 calls long. You could close the long spread and be in a call credit spread, short in the market. Close the short side and just keep the call debit spread, be long in the market. So lots of choices. You could also break the legs apart and just change the width of one of these. So let's look at a butterfly, kind of get the idea that it's a tent shape, and we need to land within the tent to be profitable. Think or swim is froze. We just got to give it a minute. Wakey, wakey. So it is really janky today. There it is. This is the typical average everyday butterfly. And one thing that we could do, if it's not behaving the way that we want, is that we can change the ratio because this is 15 wide on each side. It's equidistant. But if we change the ratio width so that it's not equidistant, then things look a little different. So now it's $10 wide on one side and it's still 15 wide on the other. And as you can see, this trade would actually stay in profit unless we get run over. So this trade starts as a credit, and unless the S&P goes all the way up to 58.85, this trade doesn't lose. And the sweet spot is 58.75. So as long as we stay below that 58.80, you'll make at least the credit of $30, 40 now. It's moving around, and it has a possible payout of 1,000. But as I've always said, never expect to get max profit on a butterfly. A 30, 40, 45. That's a great example right there. In fact, let's build that real quick just to show people what it looks like. So someone in the chat has uh, a spy. It is nice. That's why I'm gonna build that. Let's take a look at that one. We got spy. What expiration you got? Wow, my Thinkorswim just like fell over. Just so laggy all of a sudden. I'm gonna turn off trading views since we're not using it. Okay, we got April expiration. 5:30, 5:40, 5:45. All right, wait. He's using the monthly. Just right click on this. We'll let it build it and then we'll adjust it. It seems to be the easiest way on Thinkorswim. So 540 in the center, 545 on one side and 530 on the other. Throw it over into the Analyze tab. And as you can see, I got something else on. There we go. That's not what I had in mind. What was your original 50-cent credit? I got you. Let's bump that credit up. All right, so in this trade, as long as it stays above 535, let's just, easy number, stays above 535, then the trade doesn't lose. Sweet spot is 540, and as long as the market doesn't break that lowest level, then the trade has a minimum of $50 credit. This trade took a lot of that upside risk and put it on the downside. That's why this depth is so big down here. If you think about a typical butterfly, the losses are normally equal. So when we take one of these and it has no loss on this side, well, where'd all that loss go? And that's what I try to show people or really get the hint across is you didn't get rid of that risk. You just moved it and you put it over here, but it still exists, right? We can't get rid of that risk. We just moved it. So not a bad play, actually. I like this. Wasn't exactly what I had in mind, but I like it. The reason I say it doesn't fit what I had in mind is because we were talking lottos, and this is definitely not a lotto. But this is a good play because with this time frame, you really got to think 540, 535 in the next 28 days. It's the standard question I typically ask people is when they say, "Oh, I can't find anything to trade. I just don't know what I want." Trade the indexes right now. They're doing really good. And oh, I'm not good at direction. How do I know if it's going to go up, going to go down? Well, none of us do. But pick a line, 530. You think we're going to go to 530 in the next 2 days, 2 weeks, 1 month? And if you can answer that question, no, I don't think we're going to go to 530 in the next month. Well, there you go. You just built yourself a trade. Put on something that says, I don't think we're going to go lower than 530 in the next month. And that's what this trade just did. So we are out on the weekly on SPY. I shut down a lot of trades, a lot of charts that I hope had open. Maybe that'll fix the problem. So we're out on the weekly. We can look at 530 and we can see that to get there, we've got this candle of control back here. It was the September 2nd and September 9th. Those 2 weeks with that is what do you want to call those? Railroads or tweezers? It's not necessarily a tweezer because that wick on the bottom, but they are the candle of control, those two really big candles right there. And that low, there you go. Yeah, that fits. We would have to break that 540. And I think it's going to be really hard to break that 540. That's your protection right there for this trade to not get punished so badly, right? The 535 is where things start to go wrong. 534 and a half. And your protection is at 540. So that's a good deal. Have you taken a look at banks, bro? XLF? Yeah, they're looking pretty bad. There was some quants that were talking in the last few days about banks, and the more they talked, the more I was like, I want to short them so bad. Me too. And fractional shares. Yeah. In the in the current market environment where we're seeing a lot less M&A deals, we're seeing all this money leaving the United States, outflows and ETFs are picking up, bonds and yields. I mean, I don't know what's up with yields, but it's not looking good. You know, the idea that banks are about to feel it and they're going to have to come out in that next earnings report and really give some guidance. Now, to be fair, you know, when we talk about XLF, for an example, the financials, that's a really broad brush, and it captures insurance companies and trading firms, credit cards. So, generically speaking, XLF really looks bad, but there's some names in there that still look decent. Not this one. This is Visa, and while Visa's been a juggernaut to the upside, the last 2 weeks have been punishing in this thing. It's going to break at some point. With all their overhead and their buildings and their employees, and you try to compare that with these smaller uh, fintech that are so much more nimble with less overhead, we have this massive head and shoulders being formed on JP Morgan weekly chart. And I know it's a head and shoulders, so the running joke always applies. But it is there. We got the left shoulder, we got the head, and we've started the bounce for the right shoulder. While I always like to poke fun at these, I do have some rules. I don't like the right shoulder to go higher than the left shoulder. It's just a preference of mine. If it does, it doesn't mean that it's invalid. I just like it less if it does that. The head and shoulders joke is that if the only basis for your trade is a head and shoulders, it's probably a junk trade, right? That it's the last thing you would ever want to base your entire strategy on. It's like, well, I got a head and shoulders, so I'm going to trade it short. Bad idea. Really bad idea. And it's also one of the most popular patterns that new traders find, right? Out of all the patterns out there, it seems that new traders really love to gravitate towards the head and shoulders. So it's like you'll see these posts on Reddit or all over the place, FinTwit, where they, oh, I got a head and shoulders. I'm going to short it to the floor. It's trash. It's done. It's broke. And the only basis for the trade is the head and shoulders. Probably don't want to take that trade. You want to have a lot more than that. And if it's just a part of what you've already found, great, no problem. Just don't start with that one. Um, Oddly enough, Investors Business Daily has patterns that they really like, cup and handle and that sort of stuff. And they've got some really strict rules about how many candles you need on a weekly or a monthly time frame. I can't even imagine a monthly head and shoulders. It would take a year to unfold, but whatever. There's traders who do like this pattern, and you can get strict with it. You can have some really great outcomes. I've just found over the years that you definitely don't want it to be the only criteria you have for the trade is that you found a head and shoulders. They were talking about the Condor King on Spot Gamma, and they mentioned JP Morgan's collar coming off. I was reading through their note real quick. I could have swore it was this morning they mentioned it, but it might have been yesterday morning or even last night. I know they recently wrote about the JP Morgan collar though, which they often do. If we get near those strikes, they'll point them out, be like, "Hey, these things matter. Watch out. It's going to swell as we get close to it." But I do post those in the chat. You guys can go back and check the founders' notes over the last few days. They talked about the JP Morgan collar. It's funny that I put the fib on it and spotted the halfback at 252, and that was where I marked the head and shoulder on the left side shoulder. So it wouldn't surprise if we come up and test that 250 area. Absolutely love it. It's funny how many people I run into and they're like, "Can you point me to information on that?" Like, just candle books. They actually talk about it in there. They just don't elevate it to the level that I think they should, but they do mention it. What kind of energy? I listened to that podcast. That 200-day moving average, if anybody wants to take it over the long term for a broad swing back up over, say, the next couple of years, got to get through that. It's a downsloping 200, which is a bit of a concern. This is a newer company, 4.5, 5 years. We are at IPO right now. So all the running to the upside that it did up into $60 and all that, um, it gave it all back. We're right back to IPO. I don't see any splits or anything like that. Don't know if I'm missing them or if there just hasn't been any. But we are at least back to IPO. We're not underneath it and sagging nasty. I just don't like that we're back to it. Their stock started to get a little better over the last two earnings. Back in August, they were at a minus 40 cents a share on earnings. And then in November, they were actually positive, just 5 pennies, but they were positive. And then on this last earnings, it was 13 cents. So it more than doubled their last earnings from 5 cents a share to 13 cents a share. And that accounts very likely for the higher high that we got here, or this higher low, I mean, comparing those last two. So it's trying to turn the tables. We got those sellers at 10.5 that I would be concerned about, but we're above the 20-day moving average. We we have a 410 cross, which is what we call a surge signal. The mean is the 10, so call it 980 just for some easy math. If things start to go wrong here, 980 is the stop, the mean. You start getting under the mean, then you can drift to the other side, but that way you got something relatively close, talking about 40 cents for a stop. And that's for those of you who like hard stops. I'm not a fan personally of hard stops in this environment, but to each their own, right? This this reversal is a very beautiful shape for those of you who are learning price action. Look at this really long tail and this tiny little body up here at the top, and then the massive gap that came with it the next day. And they didn't close the gap when they started to fall. It just picked around and turned and just kept right on running to the upside. That is such a bullish reversal that if you were looking at as a day trader, you saw something like that, you could start on the red day because it's worth it just that. If you see that near the end of the day and you're shopping around for a play, that's worth a trade. You don't know if you're going to get this follow through, but it's worth a play when it's off a key level like that and you get that big of a reversal in the same day. It's worth grabbing it. And if you find it the next day, fine. It's okay. It'll show up on your gap scanners the next morning. Still a play. Really nice reversal. Mm. The price target, if you had grabbed it early, like I was talking about, would have been the 20 period, and we did that. But it when it got there, it found support at the 10 on the rejection, and then it ran up and took that 20. So it's still showing that it's got juice. The concern is the box that I marked that's $10.50. And when you find something like that, you can go and try to trace it down. You got footprint charts, volume profile. You have the options tab if there's anything in there worth looking at that you can try to see, hey, what's at 1050, right? And see if they're positioning anywhere around that 1050 area. Maybe they are, maybe they're not, but you can at least look, right? That doesn't cost you anything, a little bit of time and effort to go in and just see, hey, what's at the 1050 area? With something like this, if it has weeklies, just ignore those when you're looking to try to find where the big dogs are. Gravitate towards the monthly expiries so you're not hunting through every one of those weeklies. If you don't find anything on the monthlies, then just follow up, look into the weeklies anyways. But you're looking for a 1050 area, and we can usually do that pretty quick. We just open up all of these. I keep my eye on options, open interest and volume side by side, and then I just scroll down relatively quick, looking for a massive position. We can see April's got a good size. Keep going. May, lots of players in May, June, so they're farther out. They're uh, not too scrunched up in the front, and you want to see it spread out. You don't want everything piled into the front end because then it shows they don't have any interest in the longer term, and then you shouldn't either. If they're willing to participate all the way out to December, then it kind of gives the idea that they're looking farther out. They're willing to get vested interest in this thing and put money where their mouth is. We've got them clocked all the way out to January 2026. Now they've got a lot of positions between $6 and $9 too, all over the map, right? From 6 to 10, really, they've covered it. I see a lot of positions around 6 when we go farther out in time. Don't let those puts scare you. If you guys are unfamiliar with options, the institutions will sell puts and then they'll buy calls, or they'll just straight up sell puts. So if you see a bunch of puts in open interest, don't immediately assume that they were running out there buying a bunch of puts. They could buy puts to protect the position too, but more often than not, they'll sell those puts and they'll use that credit to get froggy on the other side. And then on the other side, we can see very clear positioning, 5,000, over and over again on key levels. So, they're setting up their profit zones, and it looks like they're spread out all across the board. There's a few where it's not very heavy in those weeklies that I was mentioning. It gets really light, but that's what we would expect out of those weeklies anyways when we're looking for big positioning like this. So it looks good. We can see participation long term. We can see activity. Another thing that you could check in something like this is any insider trading activity. And then, of course, you could check for institutional activity. You can do that on Yahoo, no less. It's not up to date. Usually it's delayed by the last quarter, but you can see, has institutional ownership increased in this and by how much? Then you can check the float, the short float, shares outstanding, all of that. And I didn't see a split, but that doesn't mean that there wasn't one. I don't think there was. I think I would have spotted it, but it's think or swim. We all know how that goes. And those are just ways when you hear people say, well, do your own due diligence. Those are the kind of the things that you can do. It doesn't cost you anything, just a few minutes of your time. Go in, take a look around. And you're not necessarily looking for something like a specific thing. You just want to go in there and look and see if anything stands out. We're going to get Neo, I think, in earnings. Yeah, Neo tomorrow before the market opens. And we've just gone through a whole slew of earnings. I think XPEV, and there was a couple others that were doing earnings. These things are still, I mean, anything's tradable. Don't get me wrong. You were looking for a short-term thing and it's got juice, go for it. But these things are still broke if you're looking for something longer term, a big play connected to it. Um, XPEV does have that $25, if you want to just make a nice round number. It's working its way out, but it got extended, and now it needs to come in. There's that same Pinocchio pattern on the other side, right? When we were looking at that NFE, we were talking about how really nice that red candle was, where it rallied back up and it was a signal for a play to the upside. Well, this has that really big bar, really small candle on the bottom. And while this gapped in the wrong direction, it did break the breakaway bars low, and it's still heading to the downside. This is a signal of a short, and the short's not done. So we don't want to try to look for a long in XPEV with this. But if we zoom out and we think bigger picture, since August of last year, nice run up, a good consolidation to digest that move, and then this really big run since January. Really, I mean, look at that. January, and it's just been a great run with 2 red weeks. It's very likely not done yet, but it is greatly extended and it needs to digest this. It bit off a lot. It needs time to chew it. But these, I mean, this is just one name. These guys, they have potential. And if you've been watching the gap list in the morning, a lot of those electric vehicle takeoff and landing, basically drone taxis or flying taxis, they've been getting a lot of flow lately. I called out a trade yesterday on HE in the swing tab. These guys have a contract in Brazil. They're doing tour flights, which is really it's a Chinese company in Brazil doing tours, but they got a contract. So, they don't have a lot of competition down there. Joby has a contract in the United Emirates for 6 years exclusive, and they don't have any competition over there. So when these contracts come up, and if they're able to show that they've been, commercially flying people around, getting to their destinations, building infrastructure, charging stations, landing stations, all that stuff, and they don't kill anybody, right? Everything goes good. I think this is coming home a lot closer, a lot sooner, a lot faster than any of us believe. And what's coming in the next 2 years or so? Robots. It's no joke. It's finally here. That meets what I was looking at, early 27. So end of 26, early 27, that lines up. Yeah. And I mean, hey, we're talking Microsoft, Amazon, Tesla, Google. They're all working on robots. Now, who's going to compete? Because Apple, it's focusing on like warehouse and industrial. So, they're not all working on like robots that are going to be in your house. Not all of them are, but they all have some form of robotics that they're working on. And it seems like Tesla's was the most customer, regular retail customer friendly, as opposed to a lot of the other guys that were working on commercial units for shipping, storage, labor, taking jobs basically. But I don't like that phrase, taking jobs, because there's so many jobs right now that people don't want, you know, and you're not taking a job from someone if nobody's doing the job in the first place because nobody wants to do it for the pay that they're going to get paid to do it, like buffing floors. Was it that high? It might be. My aunt runs a company where they go clean people's houses. That's what, and it's her company. She's run it for 40 years. And recently, companies have started to hire her. And she's like, I don't really do companies. I do houses. And they're like, yeah, but you do so good. That basically it was people who own a company and she cleans their house, and they're like, you do such a good job with my home. Come into my company and clean my company. And so she's staffed up, hired more people, and started cleaning companies. But oh, she makes so much money and she has to turn people away. She's like, I can't do all the work. That there's so many people who want houses cleaned, and there's just, she says, I just can't get enough people to do it. Robots would not be taking jobs from her, right? There's jobs that she's turning away because she just can't handle the workload. And she's old at this point. Yeah. No one wants to do them. So I hit AI and asked, and it said, yeah, 20 to 30,000 was his recent statement on the price of those robots. I mean, In my house, it's a team effort on all of it because we're married, and I didn't see anything in the contract that said this is yours and this is mine, and you do that job and I'll do this job. So we tend to do share the workload. Yeah, I don't know anybody whose life is like that, really. Oh yeah, my grandparents were that way. Absolutely. But I don't every couple that I know in this world, nah. Well, it's hard to argue with your cultural background. If and I can name some cultures that still do it and they're in the US, and that doesn't make it bad. If that's what they want to do that. Me and my wife, that's not what we do, and it works for us. We're happy. Yeah, that's what it's always come down to. There's always been jobs, even in the worst recessions. There's always been jobs. It's just, do you want to do it? I was living in Utah in the '07, '08 housing crisis when it just broke the world. And I was an hour and a half from the nearest McDonald's, Walmart, anything like that. So I couldn't find anything that would pay me enough money to drive an hour and a half and then work and then drive home. So I was making more money just staying at home and not working than I would if I'd have tried to go work. And so people are like, "Oh, what's the matter? I thought you could find work." You can always find work. I'm like, Absolutely, I can find work right now, but I will lose money to get to get the job to go do it. I would lose money. I'm not going to go get a job and lose money just to be able to say I have a job. I got Microsoft on the chart here. I marked out the weekly with that breakdown of the previous low, and we had a 111 reversal. We came back in. It looks like it closed the gap. If we look at that weekly gap down, if we didn't close it, we came real close to it. We missed it. We didn't close it. So there's still a gap that needs to be filled. Right now, we've got a big indecision bar, big doji bar down here, big wicks on each side. This is a lot of indecision. But if we were thinking about back to what we looked at earlier today with all the ratio charts and the growth versus value and everything that we were looking at that said the Mag 7 was not leading yet. And we think about the CTAs that are starting to buy, the post from Goldman Sachs about the 64 billion, the two standard deviation move projection. If we're looking for the start of all of this, that's a really good place to start for a short term loan. There's still the 786 overhead. So if anybody wants to be that confirmation trader that we talk about, you may want to wait to get above that 786 or draw a different projection, which would be just taking it off this low here and this high here. That drops it down to exactly 400, which is why I just rounded in the first place. Get above 400 and keep it. So a candle close above 400 on a weekly if you're looking for the confirmation style trading approach. Otherwise, I really like this level. I want to see how it opens next week. That weekly Monday open is going to tell us a lot. And I think I might be dabbling into some Mag 7 next week. Just remember, April 2nd is our deadline. So if you are fishing around and you're shopping for some short term plays, just keep your eye on the calendar because it'll sneak up on you. April 2nd, tariff date. Yeah. Yep. And I mean, he's changed it up so many times between now and then. Who knows what headlines we're going to get? He may push it off. He may completely change the language again. No idea. But from where we're at right now, roll with what we have. April 2nd is a big line in the sand that we all have to pay attention to. And we're very likely going to do it without the Mag 7 or without the indexes. No SPY, no Qs. Only one? Oh yeah, don't even get me started on those. Yep. One thing that I can offer as a recommendation is that if you take a picture of an image that has words in it, like a PDF, you can upload that to Google Documents, and the document will convert your image into words that are cut and paste words that you can click, copy, highlight, transfer. That'll work. Yeah, there's a someone in the chat says feed it to Chat GPT and see if it'll parse it out and give you the CSV. It's worth a shot. So I'm going to wrap up this stream, at least the recording part of it, just shutting down the YouTube and